Hey everyone, and welcome. So today we're going to do a deep dive analysis into one of the biggest, most influential companies on the planet, Microsoft. We're going to be breaking down a recent expert report to really get to the bottom of what's going on with its stock. All right, so let's get right to it. The big question on pretty much every investor's mind right now. After a bit of a dip, Microsoft's stock is sitting around $386. So is this the moment to jump in? Is this a real buying opportunity, or should you be holding off? Well, that is exactly what we are here to figure out. Okay, so here's how we're going to break it all down. First, we'll get a handle on Microsoft's actual business. Then, we'll check its quality, see if it has a real competitive advantage. After that, we're diving into the big one. What is it actually worth? We'll look at the pros and cons, figure out the right price to buy, and then we'll get to the analyst's final verdict. First things first, the business case. Let's really understand what Microsoft does and, more importantly, how it makes its money. Okay, so at its heart, Microsoft is this absolute giant in software and cloud computing. And, the real genius of their modern business is this shift they made to a subscription model. Instead of just selling you a copy of Office one time, they've built these incredible services like Office 365 and their cloud platform Azure that bring in steady, predictable, recurring revenue. For an investor, that is just music to your ears. It means stable and reliable cash flow month after month. And wow, look at this. This slide is where you really see the power of that business model in action. A gross margin of nearly 69% is, well, it's incredible. It means for every single dollar they make, they get to keep 69 cents before operating costs. But that net margin of 39%, that is just off the charts good. That is the financial fingerprint of a truly world-class, high-quality company. That naturally leads us to our next question, checking the company's quality. Those huge profits are great, but are they protected? In investing speak, does Microsoft have what we call a durable moat? And the answer is a big, resounding yes. As the source material puts it, their moat is all about their integrated ecosystem. And just think about it for a second. Once your business is running on Windows, using Office and Teams, with all your data stored in the Azure cloud, the cost, the time, the pure headache of trying to switch to a competitor is just massive. That is a seriously powerful advantage. And look, it's not like they have the field all to themselves, right? They're in a constant battle with other giants. Amazon in the cloud, Alphabet with its productivity software. But here's the kicker. Across almost all of its major business lines, Microsoft is either number one or a very strong number two in the market. So, to kind of put a bow on this whole quality check, the analysis gives Microsoft top marks pretty much across the board. We're talking strong management, fantastic capital efficiency with a return on invested capital over 15%, a mind-boggling $77 billion in free cash flow, and a balance sheet that's as solid as a rock. All the signs are pointing to a world-class operation. Okay, now for maybe the most important question of all. We know it's a great company, but what is the stock actually worth? Let's dig in and calculate its intrinsic value. So the report uses this really smart approach called blended intrinsic value. And all that really means is instead of just trusting one single calculation, which can be pretty risky, they use a couple of different valuation models and then average the results. It gives you a much more balanced and, frankly, a more reliable estimate of what the stock's true value is. So let's look at the two main ways they calculated this. The first method, a discounted cash flow or DCF analysis, is all about the company's future cash generation. That puts the value at about $330 a share. But the second method, an earnings-based model called MEV, values it quite a bit higher, at $417. See, you can see how just relying on one of those could give you a very different picture. And when you blend those two together, what do you get? The analysis lands on a final intrinsic value of $374 per share. This number is the report's best guess at what one share of Microsoft is really worth right now. Okay, and here is the key takeaway, the real punchline of this whole valuation exercise. With the stock currently trading around $386, it's actually a bit above that estimated fair value of $374. This is so important. According to this analysis, Microsoft is not trading at a discount. And for a value investor, that means there's very little margin of safety at the current price. All right, so we've got a number, but what's the story behind that number? Let's get a more balanced view by looking at the whole picture, the strengths, the weaknesses, and, of course, the risks. I really like this chart. It's a weighted SWOT analysis, and it gives you such a great snapshot. You can see the biggest strengths, like their leadership in the cloud and those high margins, are weighted heavily and score a 9 out of 10. But on the other side, look at the risks. Its high valuation gets a score of 5, and the ever-present threat of regulation is also a real factor. When you score and weigh everything, it comes out to a very strong but not perfect final score of 7.45 out of 10. Of course, the future is never certain, right? So to account for that, the report also lays out 3 different scenarios. The base case is that $374 value we just saw. But hey, if growth slows down, a bear case suggests the value could be closer to 280. On the flip side, if things like AI really supercharge their growth, a bull case puts the value way up at $460. Okay, so what do we do with all this? How do we turn all this analysis into an actual actionable strategy? Let's figure out what the right price to buy might be. Well, the analysis in the source material sets a very specific goal: to get a 9% average annual return over a 16-year holding period. So with that goal in mind, what is the absolute maximum price an investor should pay today to have a reasonable shot at hitting that target? And this table right here, this gives us the answer. To have a good chance at hitting that 9% annual return over 16 years, the analysis concludes that the ideal entry price is right around $310 per share. Now that is a pretty big drop from today's price of $386, and this really drives home that crucial difference between buying a great company and buying a great company at a great price. All right, we've gone through the business, the quality, the valuation, the risks. Now it's time to put it all together for the analyst's final verdict. Is Microsoft a buy, a hold, or a sell right now? So the recommendation from the analyst is broken down into 3 super clear steps. First, at current prices around $386, the verdict is to hold. Step 2, if the price were to dip below $320, that's when it becomes an opportunity to accumulate or buy more shares. And finally, step 3, if the stock gets hot and runs up near $450, it would probably be a smart time to trim or sell some of that position. So if you remember one thing from this whole deep dive, let it be this: Microsoft is, without a doubt, an exceptional, high-quality company with massive competitive advantages. But the market knows this, and its current stock price fully reflects all of that quality, which means it offers investors quality, but without a discount. And there you have it. That's our breakdown of Microsoft based on this in-depth analysis. The verdict? A fantastic business, trading at what seems to be a fair, but certainly not a cheap price. So what company do you want to see us put under the microscope next? Let us know in the comments below. Thanks for joining me.